Good morning, everybody. It is 8 o'clock Pacific time here. It's Gil here, and I got Dr. K coming at you live. Dr. K, are you on?
Live from London.
Very good. Okay, live from Playa del Rey, California here. And, we've been hanging out all week. We haven't done a webinar. And, of course, people get into, why aren't you giving a webinar? Why aren't you doing this? Why aren't you doing that? You're kind of in a position where you could be guilty of saying too much or trying to overthink things. And so we thought we'd wait until Triple Witching Day today in the hopes that maybe the market would be spinning out or doing something weird because of the triple witching action, but it isn't. It's just holding up. It doesn't really seem to want to come off. And even though this action here, you can see my NASDAQ daily chart, even though this action looked pretty bad, it's just kind of a 3 days down of selling. All the sellers bail out here, you undercut these lows in here, and then you drift back up. So it kind of tells you that they get scared people out real quickly, and then it drifts up on light volume. But that doesn't tell you anything. A lot of people were worried about this, and you're going to get a double top, blah, blah, blah. But the one thing you didn't see is you didn't see breadth really deteriorate. You didn't see any leadership really deteriorate. So you couldn't say that the market's coming apart. It occurred for a few days, and it did send the market direction model to a sell signal. But, I don't really see that as an issue necessarily either, because the point of it all is to capture a pretty nice intermediate trend, not wiggles or worrying about whether you come in here or here, wherever. You want to, in hindsight, you'd say that you'd want to see a buy signal come in somewhere here, and then you want to ride a trend. So if we're starting a new trend or we're getting another leg here in the market, then you're at the beginning, and it looks like it when you look at a lot of the charts of the leaders, that a number of them are setting up, in some cases breaking out of secondary bases, either short flat bases of 5-6 weeks or 3 weeks tight formations, as we've been seeing. For example, what are the hot stocks right now? Apple, and of course the question always comes up, was this a climax top? Well, no, it wasn't. And even on last week, when you had this action right in here off the 10-day, and you notice Apple continues to not violate or to hold or obey its 10-day moving average. So it's continuing to act well. And it's even hard to say whether this is a climax top. If we look at a weekly chart, okay, where did my weekly go? There it is. Pull it up. You can see these two long ranges here on the weekly on heavy volume. So that looks like railroad tracks. The thing is, whether you consider this, now remember this is a weekly chart here, so we're going back a couple of years, whether you consider this a first stage base or later stage base in an overall run. Now, theoretically, you can get into all this trying to label bases, and you can get into trying to determine whether it's a first stage or a second stage or a third or whatever stage. But to us, that's all just labels, and statistically, it's all baloney to us. But that's just us. Somebody else may want to operate on that basis and find that it works for them, but it doesn't work for us. And mainly because you don't need all these labels. All you have to do is continue to watch Apple, and what you know now is that it follows a 10-week line, so you're using the 7-week rule to determine, quite simply, that the only thing that's going to drive you out of this, if you're playing this for a longer-term move, is a violation of the 10-day moving average. And probably when that happens, that'll be the time that Apple finally builds some sort of base. But you don't know necessarily whether this is late stage. I don't think it is. I think it's probably just your first move up and out of here. When you have a stock like Apple selling at 12, 13, 14 times estimates, there are very few money managers, particularly if they're going to have to start moving into stocks, and I'll get into that in a second here. I don't see them selling off Apple. You would have a hard time as a portfolio manager running a mutual fund or a pension fund or whatnot and telling your board that you're dumping Apple here because it's selling at 15 times estimates, forward estimates, when the company is coming out with an iPad 3 that seems to be selling like gangbusters, and there's also the potential for an iTV. So, it's still in play, but it's running up against the 600 level. I would like to see it build some sort of a high-tech flag, but I'm not playing Apple for now. I've been playing these little moves, and I've been in and out of the stock, and I captured most of this move from here to about here. I'll give up the last 10% for now because I'd rather be playing InventSense, and I keep calling it Envision, so forgive me if I call it Envision, but I remember there was a stock, maybe it's this stock too, Envision, that was INVN. Do you remember that, Dr. K?
Oh, yeah.
Is this the
That's
same
a while
company?
back. That's the 1990s. I don't believe so.
Okay, no, but they have the symbol.
Happened to take the same ticker, that's all.
Yeah, so I'm kind of becoming like Bill O'Neill. He used to refer to America Online as American Online, and I know that was a throwback to the days when he played American Airlines in the 1960s. So in his mind, he's always thinking of American Airlines when he's saying America Online, and so it would become American with an N at the end, Online. And here I am doing a similar thing with Envision and InventSense because it's the same symbol. But in any case, not the same stock, but we've been on this one for a long time, ever since the pocket pivot down here, which was your first entry point. And then when you could have bought it, on the breakout here, we like being in here, and then we have several buy points. And for those of you who attend these webinars and watch the videos that we put up, of the webinar on our website, and you should know that we were talking about this repeatedly, watching this come into the 50-day, and Dr. K telling you all that as it comes in here, you could be buying the stock off the 50-day moving average, and of course we were, and we're big in this thing now. And for this to go to 15 to 21 is equivalent to Apple moving, I don't know, a couple hundred points, whatever. What does that move right there, Dr. K? That's about 20, 30, 35%, 40%, something like that.
Yeah, so that's,
So what would that be in Apple points? 250 points. So
right.
250 points. So you want to get excited about Apple being up, 15, 16, 17, 18 points, go ahead. I like InventSense for my money. That's where we're concentrated right now, and so far the stock does not want to give up any ground. I thought it was very constructive that you had this test last week on the pullback to the 20-day. I had an alert at the 20-day, so we're adding in here, and it comes out and very strong, pushes to new highs, pulls back to the top of this. It's acting fine, and you could just treat this as the pullback to the 50-day. I don't even think you necessarily need to define this as a base. All we know is that you have pocket pivot here, coming off here on massive volume. You get another one, you could say, coming off of the 20-day, if you wanted to call it that, or even the 10-day up here. Now the 10-day is trying to catch up. So it could go sideways and very tight. But this kind of reminds me of C-Cube Microsystems in 1995. That was a semiconductor stock playing on video technology, for those of you who remember that or read the book where I talk about it, playing that stock in 1995. Because it had a big run up from the breakout. It ran up from like the low 20s up to 49. Pulled back to 37.5, and I remember buying the heck out of it on the pullback to the 50-day, and then it headed up to about 95, 96 over the next 2 months or so. So InventSense showing a lot of power off of the 50-day moving average. It looks pretty good here right now, but we wouldn't be surprised to see it back and fill, and we wouldn't be surprised to see it continue to go higher. So our message would be, if you're in this stock and you have a good price, average price or average cost, and you have a decent position that you've been building on this move up off the 50-day, and we've been buying it all the way up, right, Dr. K, several times on the way up, and so we've been pyramiding this so far properly. So we'll see if it works. Right now it's in play. We're not going to get shaken out. You saw the stock this morning pull down into the 2050, 2040 range, I think, and I added a little tiny bit right there, but that's about it. But you see it's back up over 21, and just be careful because they'll shake you out of this thing. They tried to do it the other day on this pullback, but the way we tried to settle all of you down, if you're playing this stock, is we had Portfolio Simulator Dude, one of the biggest screw-ups around here, buying the stock coming into 19. So it pulled down a little more and then turned around by the end of the day, was back above 19 3 days ago. And of course it moves out of there. So so far it's acting okay. But again, if you're looking at this on a weekly chart, this thing is really new. It's coming out of you could consider this a flag formation, I think. I don't know if it's a tight flag, but it's a flag. And you don't really get much selling here relative to the buying as you're popping out of here. So on a weekly chart, this thing looks really powerful. And so we would think that any pullback would hold, the mid 18, maybe even as low as 18. The 50-day will probably catch up by then, but right now we're using, if I'm correct, Dr. K, the 50-day moving average is our selling guide, correct?
That's right.
Yeah, and so we talked about this as being the next Omnivision Technologies, and you guys remember we talked about this. OVTI, Omnivision Technologies, a decade ago was a big stock because they made the chips that enabled cameras in smartphones and PCs and whatnot, and now of course those are ubiquitous in smartphones and laptops. To the point where you got to be careful you don't have those things on sometimes. But in any case, we can kind of see motion sensing going that way with a variety of devices. Now, they have their work cut out for them, but like any situation that's worth investing in, it's going to remain dynamic. and the company's ability to execute is what's going to determine whether it goes higher over time. You know, Apple's always a good example of a company that continues to execute, grow earnings at a very rapid rate, and continue to come out with new products and new customers, new markets, whatever. So InventSense has the potential to broaden their reach, and I think the market sees that. And when you look at this chart, they don't have the e-signal for some reason never has the first week of an IPO, but it's trading some of the biggest volume on a weekly chart. And in fact, the last 2 weeks have been bigger. If I do this in, it probably comes up to about right here on the volume bar this first week. So this volume here is the biggest volume since that first, or that in the entire run. Actually, it's even higher than the first trading week. So it's telling you that in a lot of ways this thing is just getting going. So you don't want to get shaken out of your position. Okay, so don't. And if you're the nervous type, you know, you're not like me or even Dr. K. Once Dr. K pyramids into a big position, he's satisfied with his cost basis. He'll sit tight. And I can handle a lot of volatility as well if I really think something is worthwhile. But if you can't, then make sure you build your position in a manner that allows you to be easy about it, you know, to not get panicky if you start to see it come off a buck real fast. I noticed on Tuesday, and I know I'm babbling about this stock a lot, but I think it's an important stock in this market, frankly. On Tuesday, when you had this pullback, it looked to me like that occurred. There was a couple of filings from some insiders selling like 1.3 million shares, 1.7 million shares. It was a total of about 5.8, 6.8 million shares if I put it all together. And the market absorbed that, whatever that was, that selling came in, it absorbed it in here pretty well. And I don't know if there's going to be more insiders selling, but for now, this thing seems to act well, and I can't really fault it. So, you know, so that's one area we're focused on currently. Some other stocks, you know, I would keep an eye on. There's some new situations that I think are interesting. Keep an eye on this Tango. I think it's a smaller stock, trades about 350,000 shares a day, but they announced a secondary offering, and I'm watching this. I think this is a pretty strong move up and out of here, pulling around. You know, you'll notice it's coming back up above the 10-day. I don't think they've priced the offering yet. I think it's about what was it, like 2.2 million plus 5.8 million from selling shareholders, so about 8 million. And this is a stock with about 20-something million shares floating out there. So I think what happens here is a lot of times if it's fundamentally sound, you'll see it react positively to a secondary, because all the secondary does, as was the case with InventSense a couple of weeks or last week, well, a couple of weeks ago, it just increases the liquidity of the stock, and it makes it more attractive to institutional buyers. They like more liquidity, so really in a lot of ways these hotter, these stronger IPO situation. You can see Tango, here's a weekly chart on IPO. Comes out here, forms a little V-shaped base. There's an IPO U-turn, but it doesn't rocket out. It just slowly works its way higher. Now notice how it's loose, a little bit tighter in here, gets real tight and breaks out. And now you're holding in pretty well. So I kind of like this. You could even buy the shares here, I think, just on the basis of this big breakout, because it's acting pretty well. And I'm actually surprised at such a thin, small stock. They announced 8 million shares coming to market in a secondary, and the thing's holding up. So that seems pretty constructive to moi. Dr. Any comments on any of these names? You want to speak up and say anything, or am I?
Yeah, I think, I mean, obviously INVN is I think, our favorite right now.
Oh, definitely, yeah.
Reflection of our position size and the number of times we bought the thing, and also the fundamental story behind it. Tango also is a favorite. I'm bracketing this one with alerts prices because I'm waiting for it to come out of this consolidation here. And it is an IPO, so it's going to be more volatile, but I think it has great potential, just given the nature of its business. And also, if you look at the earnings growth, it's quite spectacular. I mean, it was always in the red up until about 8 quarters ago. Then now, you know, it's looking at 8 cents a quarter, and then by September 2012, it's going to go into the double digits. So it's got a very nice growth rate associated with this with this model.
Yeah, it's run by some older senior technology people from other companies. I think like IBM is one of them. And IBM does have a stake in the company. IBM also offers similar services, basically what they would call communications assets, the management of communications assets. And what are communications assets? You know, the mobile phones that they use, that a business uses, and they give to their employees if they're all running on the same enterprise system, whatnot. And this is a big area. There are some competitors, but I would say that based on this big volume and the good strong numbers, these guys are executing, and also the way the stock has acted since the IPO. So it's an interesting IPO to us, and I know there's a number of them out there that look interesting, and we'll answer some questions about those in a little bit. But that's very interesting to us. So meanwhile, we got LinkedIn. LinkedIn, really, this was a nice move off of here, and of course we told you about the pocket pivot here, and this is like a pocket pivot, a little bit extended from the 10-day and the 20-day here 4 days ago, but holding in real tight, and I think one of the reasons I think you can avoid candlesticks is if you look at this pattern, this is a bearish pattern. If you look at this on a candlestick, it's a bearish harami. So I don't know what that really means, but the stock doesn't really seem to be paying attention to that. We actually addressed this, our book, the one that we're writing, and I'll just give you guys a little teaser, but I'm in the middle of writing Chapter 4. Dr. Cantor and I are writing this, and this is what Chapter 4 is about, training your chart eye, and we talk about how we use charts, what you should be thinking about when you're using charts, and my conclusion on candlesticks and using candlesticks is that there are a lot of pretty patterns and a lot of short-term sort of indicators, bearish harami, bullish this, extra sauce patterns, whatever, I don't know, what secret sauce patterns, whatever. But the thing is, they'll throw you off, I think, and it gets too short-term oriented. And I think, some of the patterns that you can pick up, which is just a basic idea of institutional accumulation on a weekly chart, you don't really need much more than a bar chart. Now, you notice these charts use the open, high, low, close on it. You see the little tick here for the open, and the other tick for the close on the other side. It's kind of like a candlestick, but you really, all I look at is just closing bar. That's really all you need. So, I wouldn't get hung up on it. And I think what you're looking at here is a stock that's trying to break out. It runs into resistance at this 95 area, but I think it's going to break out. It's just a matter of time. It could shake around the 90 area, but for the most part, I think it would hold somewhere up in here, the high 80s at the very least on a pullback, and that would only be 3, 4, 5%. It's not anything terrible if it did that. You might say it's wedging a little bit, but I wouldn't get hung up on that either, because the weekly chart just shows you that you have pretty strong weekly volume coming up for 2 weeks, and I'd be more focused on the fact that you have this base here and it's just trying to break out. Once it clears, it could have considerable upside. Let's see, what else is looking Salix Pharmaceuticals, I like this name. This one acts really well. Nice breakout. They did a secondary offer. We told you guys about the pocket pivot. It's moved up higher. It's probably one of those sleepers. It's been basing a while, and maybe it starts to gather some momentum. But a lot of times these things will sit around, they'll bore you to death, and then suddenly they'll start to move. I think Biogen probably is going to eventually come out, but it's been in this long formation. It's kind of a sloppy pattern, but here you are tightening up. You might call this a saucer here with a handle, or you could call this the cup, and you have a bunch of handles for them. I don't know what you want to call it, but the way we look at it, you're in a tight base, and what we see is the action getting tight in here on these pullbacks, similar to what it did here. So it's coming out. I think eventually you'll see Biogen move higher, and that looks okay if you like slower names. Somebody asked if we need a guest author. No, we don't need any guest authors. We need ghost authors, so but then people don't write like we do, so I don't think it really works that well. Anyways, sorry, Jerry. Where was I? Okay, Biogen looks fine. Monster, this one holding up. Nothing really here. It's nice and steady, so just holding up position there. VFC is another one I think looks pretty good. VF Corp, and you see it's coming out again, but there have been little pockets in here that you can buy into. And it wiggles a little bit, but for the most part, you look at this thing on a weekly chart, it's a very tight, flat base. So you're just coming out of this base and a little bit of straight up off the bottom, so it spent some time digesting that. And this looks fine to me. I don't see any issues with this stock whatsoever. So, and there's a number of other retailers. Dr. K, you got any other retailers that have kind of been, that you have had, as you like to say, bracketed?
Yeah, there's quite a few actually, because the group's been quite exceptional. I mean, SCSS continues to to move higher.
Yeah.
PRA,
Panera.
ROST. I mean, there's a lot of these. ORLY. I mean,
Ralph Lauren, Estee Lauder. Let's see. The list goes on and on.
He has a very, very straight linear ascent.
Which one?
CMG.
CMG, yeah, I know, and CMG confounds the shorts, but you know what?
No,
There's something interesting.
the LTR looks, they're all looking good.
Which one was that?
ULTA,
Which one was that?
DLTR, DLTR,
DLTR,
and then there's ULTA.
ULTA.
Yeah,
Okay,
Lulu's still looking good.
yeah, still going. Doesn't want to
Core's is
die.
great. Core's is very interesting. A new one that I've been keeping a close eye on here is Fran, FRAN.
I knew that. I knew that was coming. But Dr. K, we blew it. We should have told everybody about the pocket pivot here.
Well, that was a tough one. Oh, you're talking about the problem with that is when you had the pocket pivot, the relative strength on this thing was pretty low.
Yeah, it's starting to come, but that's a viable gap up.
It's a little risky. It's a retailer, and it's an IPO, and it's a low RS. So then by the time it was very viable, it was extended, and then we had that viable gap up, but it closed on that low, which is tricky because when you have that kind of situation, you often want to let the stock settle, and that's what basically I'm letting it do right now is settle down, and I wouldn't be surprised that we send out a report on this thing within the next few days. It's looking pretty good.
Yeah, I mean, well, you have a viable gap up, so everybody who's been following our stuff for a long time should know that. So it trades about a 500,000 shares a day, so it's kind of thin. I mean, these are thinner ones, but we're watching some of these as they develop because I think that you want to focus on new merchandise. There's a lot of great new merchandise in this market, from LinkedIn to InventSense to some of these newer biotechs that have recently risen up. You know, Alexion, it's still new merchandise, I think, and we've been following this for a while. But you know, we pointed out the pocket pivot in here, and then you get another pocket pivot on the breakout. So you could have been buying in here. This is also a 3 weeks tight formation in here, and I think a lot of times you don't really have to worry if you see a 3 weeks tight formation and you see a pocket pivot within that formation. I think a lot of times you can just buy in the 3 weeks type formation without worrying about whether it's broken out yet, and then you can get more aggressive and get a head start when it actually does break out and everybody who reads IBD is buying it. So I think the pocket pivot helps you get in a little early on any base as well as a 3WT or 3 weeks type formation rather than having to sit and wait for the breakout. And I think that helps. You know, other formation or another stock that's been doing that. Whoops, it's not TXK. I've got Slippery Fingers this morning. You know, this one also has all these pocket pivots. And this is kind of a pattern that will bore you to death, but it looks okay. We can just run through a bunch of patterns. The Intuitive Surgical, that's just holding up fine. F5 had a pocket pivot. It's holding up tight, so it's viable on the basis of this pocket pivot. And it's finally, you know, this is really the secondary formation. As we're pointing out, CMG, Chipotle, continues to go higher. Here's a steady pattern. It's kind of this ascending chain. I've talked about this before. It did this once before back here, and then it took off. And now it's kind of doing it again. But what I noticed is if you look at the estimates in the most recent quarter, I think, you're seeing a re-acceleration in earnings coming up in the next quarter. And there is a precedent for that. McDonald's back in the 60s was having a big move, and then the stock kind of went into a funky base, and then the earnings started to re-accelerate, and it came out again and went to new highs. That was in the 60s when McDonald's was a hot new growth stock, you know, maybe like Chipotle Mexican Grill is now. But I don't know. I don't think you'll. Well, maybe I'm wrong. Maybe you'll see someday that they'll have up on their sign over 6 billion burritos served. I don't know. The way McDonald's has over 6 billion or however many billion it is now. But I think maybe they do 1 billion a day. But in any case, this continues to act pretty well. So not really any issue there. Other stocks we've been looking at, you know, Tibex on the way up, it's coming up. Never has really formed a handle in here, but you've had a number of pocket pivots. And it's part of the social networking thing, you know, LinkedIn. And I probably should mention Zynga. They're going to deal with their IPO share lockup by doing a secondary offering, which would be much more orderly. And I would watch how this acts as they price this thing and it's released into the market, because it may just set up a move out of here. And this has kind of been a sloppy pattern, so it gives it more of a chance to set up and build perhaps a proper little base in here or something. So we'll see how that goes. But I would keep an eye on that too. I mean, along with the Tango, which is it reminds me of Ted Nugent and Wango Tango. But along with Tango, I'd watch how these things act after secondaries. In fact, a lot of these new stocks, I'd watch how they act after they do secondaries. Let's see here. You know, the one thing we know that's going on right now, we saw this, you know, when silver and gold just blew apart. Of course, we got out of those pretty quickly and avoided all the rest of this pain. But it was already giving you a signal that QE is becoming less of a factor in this market, and that was confirmed earlier in the week when the bond market basically finally blew apart. And so with bonds coming off hard and the potential for interest rates to start rising next year, potentially, what you're seeing now is what you might consider a secular shift in terms of a big secular asset shift out of bonds and into stocks, which are going to hedge you much better against inflation, against rising interest rates. So you're seeing this, and this is a major breakdown here for the TLT, which is iShares Barclays 20-plus year Treasury ETF, and this thing's getting blasted. So, you know, I think there's an argument here that the market will continue to go higher, and stocks will now become the beneficiaries of a major asset and secular asset shift out of bonds and into stocks, and that's what will drive the market. You know, you'll hear a lot of people say, "Oh, you got to short the market here. It's gone too far, too fast." But you know, we all know that story. We've heard it many times before. Nice shakeout. You know, you're coming out to new highs. This thing could gain a lot more momentum before it ever starts to pull back again. It's done a nice shakeout. You don't get much selling. And I think what indicates that is the fact that you drift higher on lighter volume. And there's really not any sellers willing to come in here 5 days ago, right as you come up to the peak. So if this was a double top, nobody was certainly willing to sell it. And instead, the sellers kind of dried up here, and you see the lowest downside volume in the pattern since we started getting going earlier, or rather late in January. And so I think that tells you you're coming out of here and you're probably going higher. So anyways, I think they're telling me to shut down some applications here. I may have to do that on GoToWebinar. I don't think I have anything else up. That should do it. That sign went away. Okay, everybody hear me okay? Everybody hears me okay. Oh, here comes a bunch of guesses. Should we short using long-term bonds, or would this be... I wouldn't short bonds. Why short bonds when you can make a lot more money owning stocks? You know, you look at InvenSense yesterday up about 10%. You get a lot better move than shorting that. I mean, if you want to short it, go ahead. Coors has not violated the 10-day moving average. I'm moving to some questions now, so we'll go through these. But Coors has not violated the 10-day, right, Dr. K? Or did it?
Not yet. It closed.
No,
It closed right around the 10 days, so it has to close below the 10-day. Let me see. Yesterday it closed at 47.65. Yeah, that's right around the 10-day. So it's closing right on the 10-day essentially.
They announced a secondary too, so you're going to watch and see how that occurred. Now, you know, I don't know if you want to call this is a close below, but it's so close. You know, I think with a stock this volatile, right, Dr. K, you want to give it a little, as you like to say, porosity. I even noticed in IBD they used the term porous when describing some stock, the way it acts around its 50-day moving averages. That's the first time I've ever seen that happen. I think there also was an article a couple of weeks ago that said buying gap ups, big gap ups, is a sound buying technique. So
right. Right.
So
now, I've noticed some of the terminology.
They'll go ahead and use it. But
some of the terminology that I've used, I've noticed. Yeah, and they're not the only ones, but.
No, but it's catching. But it is, you know,
Okay.
It is a sound concept in terms of understanding how to deal with moving averages and allowing more volatile names. This thing's way up there, so if you got a low cost basis, you may want to try and sit through this. And let it build a base, because maybe after the secondary offering, you know, you've done another week in here and it comes out and turns and goes higher. So,
well, yeah. The other thing also is that on the Bible gap up, that's really where you start the count using the 7-day rule. So this stock has only traded 5 weeks. So if let's say it closes today below the 10-day, then violates the 10-day, you can make a decision. Then, technically speaking, you would be using the 50-day moving average because it violated the 10-day in 7 weeks or less.
Mm-hmm.
And this is looking great. So I mean, I would think hard about maybe keeping a core position if it were to violate the 10-day, or keeping your whole position altogether and using the 50-day
Right.
instead.
Right. So, you know, it's kind of a question. If you want to bail out and take your profits, you can always wait for another buy point to show up. You may be buying it 2 or 3 points higher, but something to think about. But I can tell you that when we make a lot of money, it's mostly from sitting and not thinking that much. And once you're up and away and you have a really nice cost basis on a potential big winner, they can go a lot higher than you think. And that's really how you make the 200-300%, you know. And that's done by sitting. And I'm not going to talk about any numbers this year at all because I don't want to jinx anything. But things, you know, this year looks like it could be a pretty good year if things continue the way they have and with some of the leaders that we've been able to play. And we can only say that we hope some of you have been able to play some of those leaders, and even that comes with, you know, having to sift through or actually getting. We started to make some pretty good money on these, and then we had to bail out. Didn't lose money, but gave up some nice profits there. But that happens, and you get back on track in the manner that you have to. So let's see. I'm going to go through some questions here. TSCO. Last week you mentioned that oil ETF did not trend. Looking back over, it appears to trend quite a bit. What oil ETF? The USO. The USO is oil itself, so it does, oil tends to have some trends, but it hasn't really had much of a trend lately. You know, here's a trend, but it's still pretty choppy. If you're talking about the OIH, the oil services holders, I mean, it'll have here's a trend here, but you know, that's there are stocks you can play doing that. So I don't know. We're not really interested in the OIH. So Save. What's your assessment of Save after the February 16th spin-out? This one here. I know, well, we had a position here, and we had bought it coming up through here, and it looked good, and then we actually ended up getting stopped out here because it's just breaking down so hard, and we'll just get out of the way. That's when we start to see that a lot of times. We just get out of the way. And it's up a little bit. It's trying to hang in there. They've had some good news, but it's a little bit slow. I don't trust it, Dr. K. What do you think?
I equate this one to Jazz when it had that spin out in April of last year. And I don't want to touch the stock for a number of months after the market makers twisted around like that. So that's my same feeling with Save. It's going to take a number of months before it redeems itself.
Yeah, pretty much so. Better other stocks to be in, like InventSense. Let's see. We talked about Fran already. Any interest in BCOV? What is BCOV? Brightcove? It hasn't really. It's a really thin stock. You know, it's probably one of the thinnest ones. So no, not really. I'd watch and see how it develops. Where would you next buy in INVN at the 10 DMA? We would wait till we saw another buy signal. You know, in INVN. I think we talked about that, but I guess, you know, if you had a pullback down in here and it tested support down in here in 18-19 area, you could buy back there. But otherwise, you're waiting for the moving averages to catch up. So just be patient. Okay, we got. Let's see. Somebody asked about BWLD. Oh, here's your Bible gap up. It's moving higher. It's gapping below the 10-day. Not really sure what to say. You got anything to say on that, Dr. K?
No, it's you know, this is a high volume mini gap down, but I don't know if it's exactly so much cause for concern. It had a Bible gap up. It's in a good group. You know, if you're overweighted in this, you might want to peel some of it back here because this is negative action for the stock.
Yeah, it's not really great. It's saying higher volume gap down.
You can probably still sit with it. I would probably use today's low, a violation of today's low, as your sell point, though.
Yeah.
So that way you keep your risk where it's trading now. You keep your risk pretty tight.
Somebody's asking, you know what? Why don't you talk about this? And I got to take a quick restroom break. But somebody asking. They're pyramiding into this off 50 days, so they have a big position. They have half their account in it. Is it a good idea to have half your account in one stock? I'll let you pontificate on that, and I'll be back in about 20 seconds. Okay.
So INVN, yeah, with any stock, you know, you have to define first of all your risk tolerance levels, which mean you might want to create a rule that says you're not ever going to be more than X% invested in any one stock. On the other hand, you should also be flexible. In other words, let's say you're up 100% on a particular stock, and that stock represents 80% of your account. You have a lot of cushion, and you have to find what fits for your trading personality. 80% position in a stock you've had 100% gain in, that might be too too much of a position size for you. You might want to trade around the core position. You might want to peel it back from 80% down to something more comfortable. Some of these winning stocks will grow in terms of the percent of your portfolio. I mean, if you have a stock that you originally bought 20% position for, and you've pyramided it, so now it represents 45% of your portfolio, and then it continues to move up from there. Let's say it doubles from there, and then it represents potentially as much as 90% of your portfolio. So it's a dynamic process where you're fine-tuning your position sizes as the market moves in whichever direction it moves. And that's a big personal exploration part of trading, is understanding and finding the right fit of position sizing to your risk tolerance levels, your trading personality. Now, there's another question that came in that has to do with diversification. It's kind of rooted in this question. The question was essentially, what happens if you find that 3 out of your stocks in your portfolio are out of one industry group, and that might make up, say, 90% of your portfolio? Well, if they're all doing well, if the industry group's strong, I wouldn't worry about it. But you do have to keep an eye on the fact that, for instance, the cloud computing stocks in 2011, early 2011, one significant one got hit, and they all got slammed the next day. So in other words, they all had gap downs. So if say 130% of your account were in these types of cloud computing stocks, you could get hit pretty hard overnight. So it is worth examining also your degree of exposure to one particular industry group, knowing that can happen, especially if it's a hot industry group. Let's see. Other than that,
I'm back.
Hello,
Okay.
Are you there?
I'm back. Yep.
Oh yeah,
Anyways.
weird. No, my audio went off for a second.
Yeah, we might have some things flipping in and out.
Yeah, no, I just wanted to finish with, the whole thing with diversification and position sizing is definitely it's a personal journey that every trader, it's worth your while to understand what your maximum risk levels are, and that way you always know where you can get out your position, or how to size your positions, especially as they grow larger as a percentage of your portfolio.
Is all T2 extended? Yeah, it's more than 5% past the breakout point, so I guess that answers that question. Why do you think Zynga went down when a secondary was rumored? Well, there was no secondary rumor. That's what they're going to do. And it's obvious why any stock goes down when they announce a secondary. They're going to suddenly increase the supply of stock on the market. So the supply-demand equation gets tilted in favor of supply, which pushes it down. So people want to focus on MCP. I wouldn't mess with this. It's trying to come off the bottom, but it can't clear this low base, so there's nothing to mess around here. I know it gets news and blah blah blah, whenever there's some headline about rare earth metals, but GNC is acting fine. Bible gap up here, it looks like. A lot of volume here when they announced its secondary, right, Dr. K, didn't they? And it's holding up. I don't think they priced it yet, so.
That's right. That's right. They announced it. Well, no, they did price it just a few days ago, and it's trading. It was priced out at $33.50. So it's trading right around that pricing level, which is probably why it's been trading very tight here. My guess is that this is very good action in the stock, and the next move will probably be higher than lower.
Yeah, it looks good. So it's acting well. So that looks fine. We talked about Fran. Okay, viable gap up. I know people are into this one, and we mentioned, yesterday somebody emailed us to tell us that there's a pocket pivot today, and that's not true. Yesterday, it's way extended from the 10-day. It's already broken out of this range, so that's not a viable pocket pivot because you're extended from the 10-day moving average. But, it's acting okay. But, again, it's a $12 stock. It's an old company. These guys make, I think it's process management software, which is great, I guess, because a lot of companies are starting new product cycles, but to me, it's okay. If it was such a hot company, it'd be selling for $40, $50, and it's because it's not a new situation. If pocket pivot volume is based on secondary pricing, should it discount the validity of the pocket pivot? Well, all I would say is this: InventSense had a pocket pivot here on the day of huge volume on a secondary. You tell me, was that pocket pivot valid or not? So, sometimes the market just kind of puts things in your face. All you have to do is open your eyes and look. And I think in this case, you can see that a pocket pivot on a secondary, there are a lot of examples of these actually, does not diminish the validity, because what happens is they dump a bunch of shares into the market absorbs them immediately. Like the ShamWow thing that the guy advertises on TV, where it soaks up everything. That's basically, it's like a big ShamWow comes into the market and sucks up all the stock, and the thing goes higher. That's very positive, and it's very valid. So when you have a buyable gap up and you buy that day or wait for a pullback after the gap, well, you buy the gap up and you're using the low of the gap up day as your stop. So, what pullback are you going to wait for? I mean, this is a buyable gap up here. You could have waited. You could just bought on this day or bought on any of these days, as long as it roughly holds the low here on the gap up. So you just buy it. You don't think about whether you're buying it the same day, the next day, or 2 days later, whatever. If it's still within range of that buyable gap up and has not broken down below the intraday low, and you can allow for a little bit of porosity of 2 or 3%, I think that makes sense, particularly in these markets. You just buy it. I remember I was reading an article back here, some guy talking about how Apple is a great company, but he sold his shares because it's going to pull back to 429, and he kind of got that one wrong. So, you get a buyable gap up, you just buy it. You don't think about it or sit around waiting to see if it pulls back first. Somebody's asking about Dana, I don't know, it doesn't, kind of boring. I'm not into it. Do you think Caesar's Palace? I don't know. We're doing, I don't know. Don't know. CZR, do I think it can move like the other ones? How do I know? I mean, that's an opinion. I would say, is it moving like the other ones? Not really. Does it have any strong earnings like the other ones? Not really. Losing $1.76, and to me, it looks like, on an adjusted basis, these guys have been losing money for the last several years. The most they lost was $12.96 in 2009. This is strange accounting. I don't know. I think this is just hype. And I mean, the one thing they do have going for them is that we will be at Caesar's Palace in May at the Money Show, so we'll be presenting there. And maybe that's why the stock's going to break out and go higher. I don't know. But, that kind of question seems silly, Dave. You should know better than that. So, by the way, Dave, are we going to see you there at Caesar's Palace in May? Will you be married by then? Maybe a baby in tow? Anyways, giving them a bad time. What type of volume are you looking for on a BGU? Well, if you read our book, it's at least 1.5 times average daily volume. So. Let's see, Flowtech Holdings, I don't know, building a base. Is that a pocket pivot? Maybe. Looks okay, but cheap stock. You guys like these cheap stocks. The only time I really like a cheap stock is when it's new. It's a new IPO like INDN or any of those. We've been talking about cores. Everybody knows now that it's not really violating the 10-day moving average. Meta assets, there's a Bible gap up. It flakes out here. It's, again, kind of a thin, small stock. If it was all that hot, it's still trying to come up off the lows of this pattern. Kind of doesn't look so hot to me.
Yeah, and also really in a trending and market environment like the one we've been in this year, you want to focus on the best names. You don't want to bottom fish. You don't want to use there is the concept of bottom fishing pocket pivots, and I would use that concept when the market is in a downspin or going sideways or going, just not going anywhere. But if you're in a strong market environment, an uptrending one, you want to stay away from names like this. These are junk, and your odds are much better going with top quality leading names.
Yeah. Somebody else saying, is this a violation? Well, if it closes here, this is the first close underneath. This is a close underneath the 10 days, so it would first have to close underneath, and then it would have to move lower. So, to me, TSCO is kind of old merchandise. I'm more into the new merchandise. IBD is watching your webinars. They never used that terminology in the past. No, I notice they do, but we still know a lot of people there, and there are still a lot of people there who like us, even though the official posture there is to treat us like we're some sort of vermin. But that's their problem. I've even heard that they have somebody, they hire people to actually track former employees, which strikes me as kind of bizarre, but whatever. We're still supporters of O'Neill, and we will be till the day we die. And in the meantime, we believe that we have added to the work pocket pivots, Bible gap ups, and really defining these in a statistically succinct and deterministic fashion has added to the work. We're not like these other guys who have their websites telling you about every breakout that's occurring. You can get that off IBD, so I won't waste my time with any of those websites. But I do think that Dr. K and I have added to the body of work that's related to O'Neill methodologies, and I think O'Neill methodologies are derived also from Livermore and Richard Wyckoff, who was the guy who really first documented Livermore's approach and implemented it himself in the market. So I would read all of Richard Wyckoff's books, and even Richard Wyckoff is the one who first came up with the analogy that if you have a business, you have to treat your portfolio like a business. Kind of the red dress, yellow dress analogy, but there's similar sort of analogy he made where, you want to be buying the stocks or the merchandise that's selling in your store. You don't want to be buying more of the merchandise that isn't selling. So, a lot of that thinking is common sense. It's all derived from Livermore, all from Wyckoff. So we see what we're doing is adding to the conversation. And you see some confirmation from IBD, but it's begrudging and it's definitely not direct. So I'll be interested to see the day that they have an article on pocket pivots because they work, and you can talk about got INVN on the breakout here. Well, yeah, we got INVN down here on the pocket pivot, so they work. Pocket pivots work. So that's all I have to say about that. Shuffle Master. This one's acting okay. I can't, Bible gap up here. If you bought that, it's just continuing to go higher, but there's no real buy points. Is green 20-day on my charts? Yeah, he's the 20-day. Really, when we talk about moving averages in the new book, and we go into some detail about how to use moving averages, I think a lot of rookies, a lot of new traders want to look at moving averages as something to follow religiously rather than to understand how a stock acts around particular moving averages, and that's much more important. And I keep a 20-day. You can almost show that this stock, when it pulls back, tends to hold a 20-day, but that's neither here nor there, I think. It's really a matter of understanding how stocks act around a particular moving average. In this case, if you understand how this thing moves and tends to dip below the 10-day, for a few days and then come back up, this move here isn't really out of character. And it's not really a stock that follows the 10-day anyways. You would be using the 50-day. Now, if you observe that it follows a 20-day moving average, then you might incorporate that into your thinking. And the one time that we did do this was last year and the year before when we were playing silver. Because the interesting thing about silver is that when it broke out through 20 and it started this big move, you can see the green moving average. It never violated the 20-day until you got to its first consolidation, and then it finally violated it here. And then went into consolidation. You had some pocket pivot action somewhere up in here breaking out. We were buying it right here, I think. And then on the way up, it followed the 20-day, and then as it accelerated, it began to follow the 10-day. But this became a climax move, and so this was an interesting example of one that actually followed the 10-day, or the 20-day rather. And that's one reason why I keep the 20-day up there. Dr. K, you just use the 10, 50, and 200, correct?
That's right.
Yeah, and that's all you really need if that's how you're operating. And Dr. K likes as little noise as possible. I got to tell you that one of the things that really caused issues for me is once I left O'Neill and I started running hedge funds. You get all these fun toys with hedge funds. The prime broker gives you a platform, and you can see every stock on the planet. And I remember the one I was using at the time had these. I forget, velocity meters next to the symbol. So if it was going down, it would have a big red bar if it was going down hard. And it was going up, it'd have a big red bar. So you got all these things, blaring at you, and they scare you out, And I actually never really used intraday charts that much at all at O'Neill, if at all. And, now I've probably overused them since I left O'Neill, and that's one thing I've had to correct, and that's something we talk about in the new book. But anyways. RAX, I hate RAX. I just hate it. And not that it's a bad stock, it's a good stock, but we bought it on the basis of this Bible gap, and it shakes out and then holds back up. Then you start to get a pocket pivot here. We buy it back, and then boom, they break it. We get shaken out again, and the blankety blank turns around and goes to highs, higher highs, after shaking this out for the second time. So we get shaken out once, shaken out twice, it goes to higher highs. Stock's acting okay. If you sat through that, I applaud you for that. But I think we had to stick to our risk management, and we will. And so we just blew out of our initial position in this thing both times. Okay. But you know what, Rex? You can take a flying leap because we'll take INVN for now. So at least we can figure this one out. But Rax is okay. If you still hold it, it's okay, right, Dutch? Okay.
Looks good to me.
Yeah, looks fine. So nothing to worry about there. DDD, 3D Systems. A lot of people talk about this one. It's just coming up in a big base, so nothing to get excited about yet. UA, Under Armour, coming out straight up. Just kind of trucks higher. I don't know if you call this a handle. Probably a couple days. That's probably enough for a handle. IBD will tell you 2 to 3 days is what you need for a handle, but we knew that a long time ago. I mean, we observed that back in the late 90s, that 2 or 3 days you could have a handle. Sometimes in late 1999, you actually sometimes you have 1-day handles. Remember? Dr. K, you remember those?
Yeah. The real fast. I mean, and you had to be really on the ball there. How fast that market moved to the upside.
Whoa, too many fingers. Fat fingers there. Okay, VMware. Coming up out of this nice big base, and it's issued some pocket pivots on the way up. It's been slow and it's starting to get some momentum, but it's pulling back in. So we don't really care for this. Again, this is kind of a sloppy base, big double bottom. Maybe it works. It probably will, but CRM is probably the stronger one in this case. But again, it's coming up towards its highs after the Bible gap up. You can even see it kind of flipped out a little bit, but it did hold on an intraday basis. So I tend to like that better. F5 looks okay. I think RATS is also a big cloud play, and so it looks. I mean, VMware looks fine. I can't say there's anything wrong with it. Guidewire software. I think this is an interesting and intriguing situation. Been looking. This is a buy point here, but the earnings are a little spotty. Dr. K, do you have any comments on this one? I mean, but it's acting well. I can't really fault it. It's a Bible gap up. You'd have to see if it settles in if you wanted to buy it at this point, if you didn't buy it on this pocket pivot. Dr. K, any comments on this one?
Yeah, I'm watching this one like I'm watching Fran. There's some defects in the fundamentals and also just in the pattern. It's a bit thin, but it did have a Bible gap up. It's a bit risky at that point just because of the nature of the stock and its flaws. But I'm watching for a potential pocket pivot out of this consolidation.
Yeah. Dunkin' Donuts, we talked about this one last week. Let's see, where are you? Dunkin', I like their symbol. So, breakout, nice breakout. It's trucking up. So, Dr. K does not believe it is the Krispy Kreme donuts, though, of 2012. Krispy Kreme, as you know, had a nice move, I think, back in 2000, 2001, somewhere in there.
2001, yeah, in the middle of that bear market.
But wait, is there something going on with Dunkin' Donuts that we don't know about? Are they offering a special policeman's discount or something? Like I told you guys last week, I love Dunkin' Donuts because it makes my neighborhood probably one of the safest neighborhoods in LA because, cops are down at Dunkin' Donuts. I actually saw somebody send out a picture of a Dunkin' Donuts next door to I think it was the Boston police or some Pennsylvania police, somewhere on the East Coast, a police station. So, and it said location is everything, and that's certainly the case for Dunkin' Donuts in that case. But kind of a sloppy pattern. I don't know. Can I scale this?
I think
differently?
it's going to be like a McDonald's. One of those. It's a big company, and I mean, unless there's something they've changed about what they're doing, and I don't see any evidence of that. I think it's just Dunkin' Donuts, and they're everywhere. So I don't see this being a stock that blows the doors off the competition like Krispy Kreme did once upon a time.
Right, and I would say United Rentals is probably, it acts well, but it's similar type of situation. It's an old stock too, acting well. The big giant base, is this a big pot or what? I don't know. But there are better things. It looks okay though. I can't say it looks bad. Value Click. Let's see. I don't know. I don't really. This one doesn't catch my eye. These things don't. Isn't this an old name from way back when? Yeah. This is part of the .com craze. I don't really care for it. Their earnings look okay though. I mean, yeah. Next quarter -7% estimates. It's kind of one of those middle stocks. It looks okay, but not anything that to me looks like some massive winner that's suddenly going to rock it. I mean, let's just look at what's done well so far since January. You can look at some of the better acting stocks. And you have the Michael Kors, you have the InventSense, you have I think LinkedIn has acted pretty well. You've seen Monster act pretty well. You've seen some of the better biotechs like Alexion act well. So I think there are more dynamic stocks if it comes down to that call. Is this let's see, Magic Jack? Okay, I remember. Call used to be the symbol back in the early '90s. There was a company called Fleet Call, and they were doing wireless or radios for the trucking industry, and then that became, I'm trying to remember, a very hot biotech, or not biotech, network technology company or phone wireless technology company. I'm trying to remember what that was. But it's acting okay. There's nothing really wrong here. Nice big reversal today, so it's fine. But it's a thin stock, so I'm not really that interested in it. NVO, somebody's asking about NVO. That's a Novo Nordisk. It continues to act well. I think this argues for moving out nice and tight base. It's a big drug stock, so big pharma as they call it, and I think it looks fine, acts fine, so nothing wrong there. But I'd rather own, I think Intuitive Surgical is a stronger name to own in the medical area, and some of these, I think Alexion is a better name to own in biotechs. I think Biogen is kind of like Novo Nordisk in that its spacing and probably moves higher too. But you never know. Some of these things, if they get real tight, this thing had a lot of strong action and it's held. Favorite stock because he's a big gun collector. He lives out in Dallas, and as some of you know, he is working with us on the managed account program that launched just the other day, and he's handling that. But Sturm Ruger's acting fine. This is it on a weekly chart. It's just very tight and acting well. So Yoku, I'm not bottom fishing pocket pivot. This is. I don't, no, not really into it. I mean, that's a big gap up, but it's not really holding. So there are better names. Cree doesn't hit my radar screen at all these days, and it's just trying to come off the bottom. So this isn't. I know every once in a while we talk about a bottom fishing pocket pivot, but then everybody sees a bottom fishing pocket pivot in everything, and I think there's a quality issue, and I think that is it. The better stocks. The bigger stocks that have these bottom fishing pocket pivots, like the LinkedIn coming off the lows, had a nice pocket pivot off the bottom there, and there's a couple others. Green Mountain, Netflix did, and they had nice moves. They will tend to have the bigger moves, but a lot of times it doesn't carry out into a situation where it comes all the way back up and becomes a new leader. It just has a pocket pivot off the lows, like Netflix did, for example, back in here, and then it's able to continue higher. But there's usually the big factor is that it was a former big stock, and you can see these. If you get carried away with these, here's one, and boom, it breaks down because it's low quality. So it tends to work better with more established, bigger stock leaders. Okay, so and it's a little still dicey. I've seen it work with Intuitive Surgical. I've seen it work with Google. I've seen it work with Netflix, Green Mountain, but not really many after that. So I wouldn't get hung up on it, okay? And the thing is, psychologically, a lot of people get drawn to that because they want to buy something cheap. But better to buy things that are expensive because you make a lot more money just buying Apple on this gap up and sitting. You make a lot more money just buying InventSense on this pocket pivot and this breakout and then adding here and sitting than you would trying to play these things off the bottom, even though psychologically it's very attractive because you think, oh, I'm getting something cheap, and it used to be trading at 200, and now it's trading at 20, and it's a bottom fishing pocket pivot. I think that's not really where you want to go. I mean, what I'll do is I'll trade some of these as short-term trades, and that's it, like Netflix or Green Mountain on the upside when they start to come up off the lows. Otherwise, like it's something like LinkedIn, I tend to see that as a constructive sign that things are starting to rebuild. And then once you get a very viable move like this, I'm more inclined to come in there. But again, I think you have to look at LinkedIn as a much more viable play, say on the whole social networking thing, which Facebook coming out next couple of months is going to drive a lot of these. So. Somebody else asking, what percent volume do you want to see in a Bible gap up? Again, 1.5 times average volume, so 150%. Fio, Fio, Fo, Fum. It's acting okay. It's just moving sideways. But again, here's a bottom fishing pocket pivot. Now, this might have more potential because, number one, it's cleared here. There is a fundamental reason here, but it's going to take some time because this thing really got smacked here. There's a lot of overhead. But you see this really massive volume coming in. Somewhat overshadows some of this, but I think it's got a lot of time to put in. You know, I can say we have a tiny position. We just kind of bought a little one in here just to see whether it does go higher. But there's a couple of things I think might be working against us in the short term, and that is that you have a double bottom here, but the second low did not undercut the first low, so you're not really getting a shakeout. On the other hand, if you look at the weekly chart, again, they don't show the first week, but if we go back and look at the big volume, if you look at these two bars here, this is the biggest weekly volume, and that even includes this first week, which will only go up to about right here if it was on here. So I think all three of these weeks, in fact, yeah, all three of these big blue weeks here are higher weekly volume than the first week that it traded, okay? So I think that's telling you that money is moving back in here, but it may take some time. So I'd like to see this act constructively. Our approach here is just going to have a tiny position, and it would become a source of funds if it does not perform because we have other stocks we'd rather be force-feeding money into. So, and I should also mention something. You know, the fund that we run generally, what we do is on a market direction model signal. We come into ETS, but what we noticed in January is that you weren't getting a buy signal on the indexes, and we had to move to a strategy of going after individual stocks in order to play upside. And so I think that in a lot of cases, you're better off trying to own stocks in here than ETS because the indexes might be a little bit slower than some of these leading stocks. Let's see, Baidu chart. We're getting to 9 o'clock here, so we're going to try to wrap up quickly. Baidu's moving sideways, okay, but there's nothing there. So could you please talk about PMs briefly? There's really nothing to talk about. PMs are precious metals. But there's nothing to talk about. They're out of play. So you're just sitting there. We got out of those things on the first break, and you know, what is the old saying, Dr. K?
Sorry, what?
What's the old saying that something like the fastest or you're quick as the quick and the dead. That's it. You know, when this starts to happen, we're just gone. We're just out of there, and we don't even think about it anymore. I'm not a gold bug. I'm not a silver bug. I know Fox News wants to pretend I am, but I'm a stock guy. Let's get real. And we played these really well. I still have physical gold and silver that I bought when gold was trading below $300 an ounce, when silver was trading around $4 or $5 an ounce. And those are my hedges against future currency devaluation. So I'm sitting with those. But in terms of playing a short-term trend or even an intermediate trend in silver or gold, it's totally off the table. So you shouldn't even be messing with that. And we would not be sitting here telling anybody to be buying here on the pullback because it could go further. And there's no signs of it abating just yet. So do you think Priceline is too high? Well, it was a buyable gap up here, so it's extended, and you don't have any other buy points, so you can't get in too high to be getting. I mean, you got to understand buy points. It's not a matter of thinking that something is too high to get in. It's a matter of being able to find a buy point and then to be able to employ sound risk management rules in terms of determining an exit point if you're wrong, and then coming in at that point, not having an opinion that, oh, is this a good place to get in or is it too high? The question you should be asking is, does Priceline show action that, number one, is positive? Yes. And number two, is it at a buy point? Well, no, it's not. So the last buy point was a viable gap up here. You have to wait for the next buy point. And, of course, what you want to watch for is if we have a pocket pivot report. So will you be updating your recommended book list? I don't know. Well, I haven't seen too many new books. There's a couple, but probably. I don't believe that their view of you is as bad as you think. Someone from their company recommended Mocha to manage funds for retail clients. Mocha doesn't run money for retail clients. Okay, so IBD is made. But like I said, there are actually a lot of people that still like us at IBD and at O'Neill. And I don't. It seems kind of bizarre to me. There are some people who, for some reason, have a bug up some part of their anatomy, and I'm not quite sure why. But that's whatever. You know, I think a lot of people have told us, quite frankly, that because of us, their IBD subscription has become more useful. Okay, so I think we're helping. I don't think we're hurting, and we're happy to do so. So in the meantime, we are very strong supporters, and we are institutional clients of O'Neill, and we're good clients. We take services, and we pay our bills on time. So having worked as the manager of the institutional services division, I saw several former O'Neill people go off and take services that they never paid for. You know, they'd be late paying, or they wouldn't pay, or they'd build up a deficit, and we'd have to cut them off. So we strive to be a good customer in that regard. Is there a stiff? Let's see. Why isn't the 20-day MA used for pocket pivots and violations? Because it doesn't figure out statistically, right, Dr. K?
10-day works. 20-day is something that, again, someone could use a 20-day, but they would have to create different rules around the 20-day.
Right. Right. Okay. SWI is acting fine. Nice little 3-week base, a flag formation, acting fine. Watch for some sort of pocket pivot coming off the 10-day. You actually did have one right here, but it didn't get above the 10-day, so it wasn't a pocket pivot. But it's acting fine. Acts fine. What is your definition of new merchandise? IPOs, or in some cases, a big cap old leader that has reinvented itself in a major way. So. In that sense, you would look at Apple in 2003, 2004 as being new merchandise, in that it had pretty much disappeared for a couple of decades, and here it was reemerging with some new products that were making a big splash, and so that could be considered new merchandise. But I would say in general, think of new merchandise as new companies that are pushing the envelope, that represent the newest technologies that are being deployed in the economy, and where they're able to get traction in terms of earnings and sales, and they're compelling conceptually as well. And that also would go for like an Apple reinventing itself. That happens from time to time, and so that's kind of what we're looking for. Things that haven't been overplayed, and there is a little bit of judgment employed when you're doing that. So Domino's Pizza. The story on Dunkin' is coffee, not donuts. Okay. Domino's acting fine. Bible Gap up, holding the 10-day. So just about to wrap it up. Dr. K, do you do distribution day counts in your analysis for MDM's signal?
Yeah, sure, that figures in.
So, yeah. Oh, we have somebody says, from a police officer, we love Dunkin'. Food stinks, but it's better than gas station coffee. Well, yes, and we like police officers. I have friends who are police officers. I grew up in a blue-collar neighborhood, and several of my friends went off to become police officers. And I would say that most of these guys, you get a bad apple here and there, and of course there are the guys who do nothing but hang out at the donut shop. But for the most part, I'm going to say 99.9% of all cops are trying to do the right thing, and we thank them for basically putting their lives on the line. And let me tell you, in L.A., they're putting their lives on the line frequently. Not too long ago, there was a guy killed, officer killed right here on a stop right near the airport. And so, anyway, I just wanted to pass that out to the officer who is listening to this. So. I don't know. In some ways, I think police are more useful to society than some of us traders, but that's another issue altogether. TransDigm Group is holding the 10-day pullback, still trying to build the base. Fire, I'm going to try and get through these last questions. Same thing here, just holding the 10-day and continues to act fine. Dr. K, if you have anything to say about any of these, let me know. We don't like bank stocks, BAC. I'm not going to buy any of these. I mean, that's constructive action, I think, and it's strong for the market. And that's, we would be leading those alone for now. So UBNT, Ubiquity, I told you guys about this when it was in here. It's a very volatile stock. I don't really like this. I'd rather play something else, but it might work. I'm not going to short anything in this market. We had talked, it looks like it's a downside reverse flag, but I think you're going to be better off being long stocks than trying to be shorting stock. I've been trying to come in on Amazon, and it looks like it wants to break. It looks like it, but it doesn't really want to. You notice you pick up some volume in here off the lows, and there's not a lot of selling. And it's really difficult to say one way or another. Sure, you see the head and shoulders, but if you're not in a bear market, it may not break down. It may actually set up, get tight, and turn around and go higher. So I'm not really playing the short side, and why do I need to when I can make 30, 40, 50%? And if you're running a 100% position, in InventSense as I am, I'm not going to tell you what my other 100% position is, and you're up, 30, 40, 50%, you're making 30, 40, 50%. So no reason to really try being short. It's like, what gives me the most love, it's kind of that way. And so InventSense gives you more love on the long side than Green Mountain or Amazon do on the downside. Anyways, last question. LinkedIn does not seem to have very good IBD stock checkup ratings. Well, I don't really care. It's one of those exceptions. You know, if you go back and you look at the internet.com boom of the late 90s, a lot of those stocks didn't have very good IBD ratings per se, but there are some exceptions, and if you go back and study historical examples, there are numerous exceptions. And usually when there is a compelling and overriding theme to the stocks or the group, it's when sometimes some of that can override fundamentals. Do you have anything to add on that, Dr. K?
Yeah, I remember, mentioning to Bill O'Neill about, how a lot of these stocks were in play that didn't have any earnings, and he, at first he was very against that idea because he said, no, you only buy stocks with earnings. And I said, well, the paradigm's changed. And we had this conversation in, this would be sometime in '98. So, it was in the middle of the throes of a lot of these dot-coms coming onto the market. And didn't take him to his credit, didn't take him that long. I think it was probably 3 conversations after that he started to think about stocks that have a great sales metric. So great sales acceleration, even though they have no earnings, such as Amazon. That's one of the famous examples. And so that, to his credit, he was able to switch gears, switch his thinking, that he'd stayed with for, 30 or 40 years about earnings, stocks with earnings, to switch to the new paradigm.
Yeah, I think that's one of Bill's great strengths, that even though he is an old codger, you run into a lot of guys who've been in the markets for years and years, and a lot of them would not believe the late 90s because in their experience they'd never seen anything like it, and they relied on valuations and all this other stuff, and everything was just priced too out of whack. But, Bill saw it, and when he sees the evidence and what the market's telling him, he's the first one to make the move. And so what we started doing, and you can actually read about this, there's an interview with Dr. K and myself in the book by TradingMarkets.com. I think you can get used copies of it. I'm not sure. It's called The Best TradingMarkets.com's Conversations with Top Traders. Dr. K and I are in the first chapter as the disciples, and that's actually where we get the name of our book. Trade Like an O'Neill Disciple. That's where we get that name. It's from that original chapter, and it was written by Kevin Martyr, ironically, who is today my cohort or colleague putting out the Gilmore Report. But in any case, we were using sales as a metric instead of earnings, and that was actually pretty reliable. So, the market knew there was a big theme going on with the internet back then. It was trying to figure out a way to price it, and since the earnings weren't necessarily there, it was grasping onto sales metrics. So that was really the psychological, latch that got people hooked on how to measure these things and how to assess them and run them up like mad. So again, you don't want to get too boxed into this need to label things as having certain IBD ratings or whatever ratings you're using. There is room for flexibility, and you do have to be able to watch what price volume action is telling you, and you also need to be able to employ some judgment in terms of understanding what is an overriding and compelling fundamental theme. You remember Molycorp a couple years ago, big move, wasn't making money, but the rare earth theme was brand new, and it was a very compelling one that drove it higher, and it never had IBD ratings, yet we did catch the moves on that and the pocket pivots as that thing came up over the last couple of years. When it first started out, you guys may remember, we caught this pocket pivot coming here, and it had a nice move. So back then, Molycorp didn't have your classic ratings that you'd want to see, classically speaking, but it did have the compelling and overriding fundamental theme, which was the rare earth metals shortage that drove it higher. So a lot of times you have to weigh all that in as well, okay, and that's what we do. Anyways, on that note, I think that's all I've got. Everything looks fine. Remember, we're triple witching today, so expect that these stocks are going to be a little bit funky and swing around. We saw InventSense drop down to about 2050, a little bit lower earlier, and now it's swinging back above 21, but it wouldn't surprise to see it, diddle around here for a while and swing around. Don't get shaken out if you have a low cost basis. We like the stock. We think it has a lot of potential. Anyways, that's all we have to say. Dr. K, anything to finish up with?
No, let's just keep riding this trend.
All right, very good. All right, everybody. Take care, and we'll catch you next time.
So long, everybody.
The organizer has ended the session.